funds sahi hai. Then why does the disclaimer say mutual funds are subject to market risk? Though mutual funds offer broader diversification and value for money to an individual, a few risks are associated with investing in mutual funds. Hi everyone, I'm Aishi from Clear. We are India's largest tax and financial services platform where we have served more than 6 million tax filers. Subscribe to our channel to get investing tips and learn more about growing your money. In layman's terms, a mutual fund is a company that brings together money from many people and invests it in stocks, bonds and other assets. The combined holdings of stock, bonds and other assets the fund owns are its portfolio. Each investor in the fund owns shares representing a part of these holdings. Just like an equity share has a traded price, a mutual fund unit has a net asset value per unit. The NAV is the combined market value of the shares, bonds and securities held by a fund on any particular day as reduced by permitted expenses and charges. NAV per unit represents the market value of all the units in the mutual fund scheme on a given day, net of all expenses and liabilities plus income accrued divided by the outstanding number of units in the scheme. The price of any security depends on market forces and the market acts on any news or development, making it difficult to predict the market's direction. It's impossible to predict the price of a share or security in the short term. There are too many factors and players that influence its direction. Thus, every investor should know that there is a certain risk to security price from an all-important equity known as the market. They should also know that mutual funds are designed to reduce this risk as much as possible. Did the explanation make sense so far? If it did, write clear in the comments below. If you still have queries, write them in the comment section and we will help you. First, market risk. I'm sure all of you have seen the advertisement on TV that mutual funds are subject to market risk. Market risk is the risk that may result in losses for any investor due to the market's poor performance. There are a lot of factors that affect the market. A few examples are natural disasters, inflation, recession, political unrest, fluctuation of interest rates, etc. Market risk is also known as systematic risk. Diversifying a person's portfolio won't help in these scenarios. The only thing that an investor can do is wait for things to fall in place. Second, concentration risk. Concentration generally means focusing on just one thing. Concentrating a considerable amount of a person's investment in one particular scheme is never a good option. Profits will be huge if lucky, but the losses will sometimes be pronounced. The best way to minimize this risk is by diversifying your portfolio. Concentrating and investing heavily in one sector is also risky. The more diverse the portfolio, the lesser the risk is. Third, interest rate risk. Interest rate changes depending on the credit available with lenders and the demand from borrowers. They are inversely related to each other. An increase in the interest rates during the investment period may reduce the price of securities. For example, an individual decides to invest in a bond of ₹100 with a rate of 5% for X years. If the interest rate changes for some reason and becomes 6%, the individual will no longer be able to get back the ₹100 he invested because the rate is fixed. The only option here is to reduce the market value of the bond. If the interest rate reduces to 4% on the other hand, the investor can sell it at a price above the invested amount. Fourth, liquidity risk. Liquidity risk refers to the difficulty of redeeming an investment without incurring a loss in the value of the instrument. It can also occur when a seller cannot find a buyer for security. Like ELSs, the lock-in period may result in liquidity risk in mutual funds. Nothing can be done during the lock-in period. In yet another case, exchange-traded funds, that is ETFs, might suffer from liquidity risk. As you may know, ETFs can be bought and sold on the stock exchanges like shares. Sometimes, due to a lack of buyers in the market, you might be unable to redeem your investments when you need them the most. The best way to avoid this is to have a diverse portfolio and select the fund diligently. Fifth, credit risk. Credit risk means that the insurer of the scheme cannot pay what was promised as interest. Usually, agencies which handle investments are rated by rating agencies on these criteria. So, a person will always see that a firm with a high rating will pay less and vice versa. Mutual funds, particularly debt funds, also suffer from credit risk. In debt funds, the fund manager has to incorporate only investment-grade securities. But sometimes it might happen that to earn higher returns, the fund manager may include lower credit-rated securities. This would increase the credit risk of the portfolio. Before investing in a debt fund, look at the credit ratings of the portfolio composition. So folks, I hope you understood why mutual funds are risky and what the risks are. You can start your investment journey by downloading the Black app by ClearTax from the link given in the description below. Download the Black app to help you grow your wealth and invest wisely. Also, don't forget to subscribe to our channel for more finance related content. See you soon.